Hello, world. Welcome, I am your host Mr. Stagg. Today we will be discussing the bankrupt financial services company, Refco. Refco was a New York-based financial services company, primarily a broker of commodities and futures contracts. A commodity is an economic good that is commonly used and bought and sold. A futures contract is a legal agreement to buy or sell something at a predetermined price at a specified time in the future. Refco was co-founded in 1969 by Raymond Earl Friedman and his stepson Thomas Dittmer as Friedman and Co., which became one of the largest futures brokers and oldest electronic trading companies in the U.S. Friedman was an American businessman, cattle trader, gambler, philanthropist, pardoned convict. Friedman was born in Sioux City, Iowa on September 11, 1913. Friedman ran a wholesale food business in Sioux City, Iowa. Friedman was convicted in the 1950s and he served time in prison for a scheme where he sold chickens that were Grade B chickens to the U.S. Army, but they were marked as Grade A chickens. Friedman would sell his position in Refco to Dittmer in 1974. He retired as chairman of Refco Group in 1999. In 1992, charges were brought against Refco and Friedman for exceeding the speculative position limits on pork belly futures while trading in conjunction with customers. From October 1990 to January 1991, regulators charged Refco did not properly supervise Friedman's trading activities. Refco settled the charges, paying a fine of $440,000 and agreed to cease and desist from future violations of the Exchange Act. As part of the settlement, Friedman settled personal charges against him by paying a fine of $150,000, agreeing to surrender his floor broker registration and sever all ties with Refco. He was also barred for 2 months from trading futures and options. He was then banned for 6 months from trading pork belly futures and options. Friedman was a controversial figure whose company was fined by the Commodity Futures Trading Commission and the National Futures Association over 140 times. He died in 2004 at the age of 91. Refco has not enjoyed a clean reputation with regulators. In 1996, the CFTC fined Refco $925,000 for customer segregated funds violations. Refco was ordered to pay the fine and modify its internal procedures and lines of reporting, among other remedial actions. In 1999, Refco was fined $6 million by the CFTC for a lack of supervision of an introducing broker and its CBOT financial floor staff for misallocation of trades. The fine was one of the largest ever issued by the CFTC at the time. Refco was also forced to pay $1 million to fund a study of how brokers receive and record customer orders. It also paid the Chicago Board of Trade a $1 million fine. In 2001, the NFA ordered Refco to pay $43 million to 13 investors after their Refco broker used bogus order tickets to clear trades. Prior to its collapse in October 2005, the firm had over $4 billion in approximately 200,000 customer accounts, and it was the largest broker on the Chicago Mercantile Exchange. The firm's balance sheet at the time of the collapse showed about $75 billion in assets and a roughly equal amount in liabilities. Though these filings have since been disowned by the company, they are probably roughly accurate in showing the firm's level of leverage. Refco became a public company on August 11, 2005, with the sale of 26.5 million shares to the public at $22. It closed the day over 25% higher than that, valuing the entire company at about $3.5 billion. Investors had been attracted to Refco's history of profit growth. It had reported 33% average annual gains in earnings over the 4 years prior to its initial public offering. Refco Inc. entered crisis on Monday, October 10, 2005, when it announced that its chief executive officer and chairman, Phillip R. Bennett, had hidden $430 million in bad debts from the company's auditors and investors, and had agreed to take a leave of absence. Phillip Roger Bennett is the former CEO of Refco, Inc. He is a British citizen who was educated at Cambridge University. In the 1970s, he worked for Chase Manhattan Bank. He joined Refco in 1981 and became the firm's chief financial officer in 1983. In 1998, Chief Executive Officer Thomas Dittmer retired and Bennett took the job. On October 12, he was charged with and arrested for securities fraud. Shares in Refco then proceeded to drop from $28 per share to 8 cents per share, before being halted and then delisted from the NYSE. Refco was bankrupt within 7 days of the scandal breaking. Bennett had been buying bad debts from Refco in order to prevent the company from needing to write them off, and was paying for the bad loans with money borrowed by Refco itself. Between 2002 and 2005, he arranged at the end of every quarter for a Refco subsidiary to lend money to a hedge fund called Liberty Corner Capital Strategy, which then lent the money to Refco Group Holdings, Inc., a company he controlled and owned. Liberty Corner then paid the money back to Refco, leaving Liberty Corner as the apparent borrower when financial statements were prepared. Upon their maturity timed to occur after the end of Refco's reporting period, the loans were unwound, supposedly without the knowledge of Refco's auditors. This meant that Refco Group Holdings, Inc. was put back in the position of owing the same amount of debt to Refco that it owed before it borrowed the money from Liberty Corner. Thus, on paper, these debts remained hidden from one quarter to another. Refco said that through an internal review over the preceding weekend it discovered a receivable owed to the company by an unnamed entity that turned out to be controlled by Mr. Bennett, in the amount of approximately $430 million United States dollars. Ross Capital has also been named by the Wall Street Journal's anonymous sources as one of the firms with losses that somehow led to Bennett's $430 million debt. Ross Capital is run by Wolfgang Flottel, whose father used to run BAWAG PSK Group, an Austrian bank that lent Bennett the money to repay Refco. In 1999, BAWAG purchased 10% of Refco in a private transaction, and had an outstanding loan of €75 million to Refco at the time the firm collapsed. On October 5, before news of the hidden loan was made public, Phillip Bennett applied for a €350 million loan, to be collateralized with his shares in Refco. The loan was granted on October 10, and Bennett used it to pay off the hidden $430 million. The Refco stock that collateralized the loan is now worthless, and on November 16, BAWAG joined the line of people suing Refco, demanding €350 million plus punitive damages in compensation for the company's failure to disclose information that would have discouraged BAWAG from lending the money to Bennett. The Austrian National Bank and Financial Market Authority were investigating BAWAG's involvement with Refco. The apparent fraud was caught by Peter James, Refco's newly hired controller. Apparently, in the fiscal quarter before the story broke, Bennett failed to execute his temporary Liberty Strategy's hidden repayment of debt. This left the position on the books for James to find. It is unclear why the firm's chief financial officer had not spotted the loan, but the firm's previous CFO, Robert Troston, left Refco in October 2004 with a $45 million payout that was not disclosed in the firm's IPO prospectus. He was under investigation by regulators, who suspected he may have known something about Bennett's malfeasance. This announcement triggered a number of investigations, and on October 12, Bennett was arrested and charged with one count of securities fraud for using U.S. mail, interstate commerce, and securities exchanges to lie to investors. His lawyer said that Bennett planned to fight the charges. On October 19, trading of Refco's shares was halted on the New York Stock Exchange, which later delisted the company. It was to be rebranded under the Refco Investment Services banner. Before the halt, Refco shares were trading for more than $28 per share. After trading over $30 in the month after the IPO in August, Refco shares lost almost two-thirds of their value over the course of 2 days last week. By the time the stock was halted, they last traded at $7.90. October 19, they had dropped on the pink sheets to 80 cents per share. Their auditors Grant Thornton and the investment banks that handled the IPO, Credit Suisse, First Boston, Goldman Sachs, and Bank of America Corp., all supposedly completed due diligence on the company, and all missed the CEOs hiding $430 million in bad debts. Refco, Inc. filed for Chapter 11 for a number of its businesses, to seek protection from its creditors on Monday, October 17, 2005. At the time, it declared assets of around $49 billion, which would have made it the fourth largest bankruptcy filing in American history. However, the company subsequently submitted a revised document, claiming it had $16.5 billion in assets and $16.8 billion in liabilities. Refco also announced a tentative agreement to sell its regulated futures and commodities business, which is not covered by the bankruptcy filing, to a group led by J.C. Flowers & Co., for about $768 million. However, other bidders soon emerged, including Interactive Brokers and Dubai Investments, the investment division of the Emirate of Dubai. These offers were for a time rebuffed, as the Flowers-led group had a right to a breakup fee if Refco had sold this business to anyone else. Carlos Abadi, involved in the Dubai bid, said that the Dubai-led group offered $1 billion for all of Refco and was rejected. However, the bankruptcy judge in charge of the case deemed the breakup fee unjustified, and the Flowers Group withdrew its bid. The business was instead sold to Man Financial on November 10. Man Financial kept the majority of the Refco futures businesses after selling Refco Overseas Limited, Refco's European operation, to Marathon Asset Management, who then relaunched the business as Marex Financial Limited. Refco's assets were sold 1 month later to Man Financial, which became MF Global, for $282 million in cash and $41 million in liabilities. MF Global Holdings Limited, formerly known as MF Global Inc. and before that Man Financial, was one of the world's largest derivatives brokers with a significant presence in OTC products and cash securities. The firm filed for Chapter 11 bankruptcy protection on October 31, 2011, and Chairman and CEO John S. Corzine resigned 4 days later, after the company got margin calls and bank demands for money resulting from its investment in distressed European sovereign debt. It was the 8th largest U.S. bankruptcy at the time. The bankruptcy filing came after talks to sell a variety of assets to Interactive Brokers Group Inc. broke down. The shortfall in customer funds on November 21, 2011 were estimated to be as high as $1.6 billion. Well-known investment company Thomas H. Lee Partners, a highly regarded buyout fund, had bought a 38% stake in Refco in 2004 for $500 million as Refco was preparing for its IPO the following year. Thomas H. Lee Partners, LP is an American private equity firm based in Boston, Massachusetts, specializing in leveraged buyouts, growth capital, special situations, industry consolidations, and recapitalizations. Refco's collapse cost investors more than $1 billion, sparking multiple suits for negligence against the firm. Thomas H. Lee Partners in turn sued Refco's auditors and former executives, claiming they hid the fraud which caused Refco's collapse. Thomas H. Lee Partners has since settled all claims by Refco's brokerage customers, bankruptcy trustee and shareholders. One institutional investor, the $120 billion New York State Common Retirement Fund, says it stands to lose about $21 million resulting from Refco's collapse. The fund was a stakeholder in Refco before the IPO through its investment in private equity funds, including Thomas H. Lee Partners, which is Refco's biggest shareholder. The New York fund was instrumental in recouping billions of dollars from the underwriters of bankrupt telecom firm WorldCom. On October 27, 2005, shareholders of Refco filed class action lawsuits against Refco, Thomas H. Lee Partners, Grant Thornton, Credit Suisse First Boston, and Goldman Sachs. On March 2, 2006, a lawyer representing Refco's unsecured creditors began steps to sue the IPO underwriters for aiding and abetting the fraud, or for breach of fiduciary duty. In April 2006, creditors sued BWAG PSK Group for more than $1.3 billion. On March 15, 2006, information leaked by the U.S. Prosecutor's Office revealed that Refco held offshore accounts holding as much as $525 million in fake bonds. The company held that securities, for BWAG PSK, the Austrian bank with which Refco had a close relationship, discussed in part above, and for a non-U.S. hedge fund called Liquid Opportunity. Apparently, BWAG and Liquid Opportunity jointly owned 6 Anguilla companies, which in turn owned the fake bonds. Refco's attorneys have declined to comment. Apparently, the 6 Anguilla companies initially responded to Refco's bankruptcy filing as a normal customer would have, filing as creditors with a combined claim of $543 million. However, they failed to follow up with any legal filings. This is presumably good news for other Refco customers, in that $543 million in potential claims on the firm's assets have disappeared. The likelihood that the fake bonds represent some kind of ongoing criminal activity does not bode well for the principals of Refco, BAWAG, or Liquid Opportunity. In April 2006, Christie's auction house sold Refco's prized art collection, which included photographs by Charles Ray and Andy Warhol. Bennett and former Refco CFO Robert Troston both pled guilty in federal court in February 2008 to fraud charges stemming from the collapse of Refco. Bennett pleaded guilty in a New York City federal court to 20 counts of conspiracy and fraud 2.5 years after his arrest. Prosecutors said losses connected to the fraud topped $1.5 billion. He pleaded guilty in February 2008 and was sentenced to 16 years in prison in July 2008. Former Refco president Tone Grant, 64, was found guilty in federal court on April 18, 2008 of 5 criminal counts related to the scheme and faced a possible sentence of life in prison. Grant was alleged to have hidden losses topping $2.4 billion. On October 30, 2008, Grant reported to the U.S. federal prison camp in Duluth, Minnesota to begin serving a 10-year sentence. He died while serving his sentence in January 2015 at the age of 70. On February 15, 2008, Phillip R. Bennett pleaded guilty to 20 charges of securities fraud and other criminal charges. On July 3, 2008, Bennett was sentenced to 16 years in federal prison. Bennett was given early release on 26 May 2020 on compassionate grounds due to health concerns during the COVID crisis at the age of 71. He was immediately deported to the UK. On July 11, 2009, Joseph Collins, Refco Inc.'s former outside lawyer, was convicted by a federal jury of helping Chief Executive Officer Phillip Bennett and other executives defraud investors of $2.4 billion. Refco was Hillary Clinton's broker during her famously profitable 10-month period of rookie cattle futures trading in 1978-79, when she turned an initial $1,000 into a profit of over $60,000. As the Refco bankruptcy was unfolding, the Rogers Raw Materials funds were caught up in the developments. Beeland Management, which manages the Rogers funds, had moved over $360 million from Man Financial to Refco the week before the bankruptcy. Refco, founded by an ex-convict, in the end turned out to practice fraud just like its founder Ray E. Friedman. Though of much smaller size, the regulatory impact of the Refco scandal will be larger than for probably any other corporate failure except for Enron.